Hey guys, today I wanted to take a minute and show you a Excel spreadsheet tool that I have developed recently. It's pretty much in its finished stage now, so I feel pretty confident in going and releasing it to the public out there. Anybody that wants a copy of this, you can find it in my Discord community as a download, or just send me an email and I'll be happy to email it to you. This is essentially going to give us the same tables that you'll find in the Never Sell book. The tables at the end in the appendix that deal with Alex's full journey, if you're familiar with the book. This is just a basically a plug and play version of that. So the original tables that I made for the book were mostly hard inputs, where I went in and actually calculated all the the amortization and cash flow and all that stuff. Most of it was just hard inputs directly into the tables. I created this version because I wanted to make something that I could give to anybody that's interested, where they could basically just plug in their own numbers, and it'll automatically update all the tables. This tool really allows us to analyze the Never Sell portfolio structure with many different variables, different inputs, different structure, even acquisition timeline, everything. You can change pretty much whatever you need to fit your specific situation. So this is going to be part of a new series of videos that I'm making, where I'm going to go over a lot of these digital tools that I use. A lot of them are just Excel spreadsheets. I have like a CapEx calculator. I have a build budget template where I budget my new construction builds. I have this for the portfolio manager. I also have like a Gantt chart where you just put in your schedule information and it automatically populates the whole Gantt chart for scheduling purposes. Really helpful there, especially on construction projects. So you can find most of these already in the Discord community. But I will have videos coming out for each one, kind of giving an overview how it's used, and then we'll go from there. If anybody has questions, feel free to leave questions in the comments, and I'll answer them the best that I can. As I said before, you can find this file and any of the other files in my Discord community. It's all free to download. Download any of these files that you want, or just send me an email, and I'll send you over a copy. So these templates are super helpful for planning purposes. In my past life, I was a data analyst in the corporate world. So I basically spent 5 years of my life doing nothing but spreadsheets. So this is kind of something that I have a little bit of experience in, building these things out and using them, utilizing them, creating data sets, and then analyzing that data, all that kind of stuff, right? So today we're going over the Never Sell Portfolio Planner. That's what I have called this. The one that you see, the numbers that you see right here should be exactly what was from Alex's journey in the Never Sell book. So we'll go over that first, and then I'll show you a couple other versions, the same file but with different inputs, to kind of show you what it looks like when you're putting in different numbers, timelines, that kind of stuff for all of this. Okay, so to start off with, we'll just start by going through all the inputs page. You can see here, if you're not familiar with Excel, probably going to be helpful if you know a little bit about it, but I'll show you the basics here of how to use this particular tool, or this workbook. So at the bottom you have, I'm kind of in the way there. So at the bottom down here, you can see I have two tabs. There's the inputs tab, which we're on right now, and then there's the tables tab. That's going to have all of the, let me click on that real quick, show you. That's going to have all the tables that you saw from the back of the book. Okay. They are set up slightly differently, but basically the same. So they should look very familiar. So first I'm going to go through the inputs page, kind of talk to you about what's going on here. And then we'll take a look at the tables, and you can see what the outputs are based on all the user inputs here. So on this page, if you're not familiar with kind of financial models and Excel calculators and that kind of stuff, it's very common that any blue text is going to be user input. Okay, so anything you see here that's a blue text, that's all the information that you need to input into the file for it to automatically calculate all the tables. So I have it pre-populated with a bunch of numbers. Obviously, in this case, it's all pre-populated with the numbers from the Never Sell book, from Alex's story. But we'll go over this real quick, and I'll just kind of outline everything that we put in for inputs here, and then we'll go to the tables page and take a look at that. So first off, global assumptions at the very top. You have an appreciation rate. This is the appreciation on the home itself. I use 3% typically as my average for a long-term average. If you're looking at a short-term plan, maybe you're only planning on holding for a few years or whatever, you may want to change that to what you feel like is more accurate for the next few years. Obviously, nobody knows for sure. This is just forecasting. That's why typically I like to use long time horizons, which allows me to confidently use long-term averages for these numbers. So home appreciation, this is the annual home value growth. 3% is a pretty typical average that most investors will use. You could drop it down to 2% if you want to be ultra conservative. But 3% even still is a pretty conservative number in most times. There obviously we've gone through a period of high appreciation over the last 5 years, really not the last couple years, but the 3 years before that, since 2020 all the way through about 2023, right? Super high appreciation. This number would have been, if you were looking at only that small period of time, let's say just the last 5 years, this might be a 4 or 5, maybe even a 6% annual appreciation rate, depending on your market. Okay. If you can, you definitely want to make this specific to the market that you're investing in. But if you're just looking to use general numbers, averages, 3% is pretty good. Rent growth, I tend to match the rent growth to the appreciation rate. That's not always going to be the case, but over the long term, the averages typically end up around 3% for both of those. If you want to be ultra conservative, again, drop that maybe to 2% or 2.5%. That would work just as well. And then finally, we have our expense growth rate. This is going to be the inflation in our expenses. Typically, this is a little bit less than what your appreciation will be. For anybody that hasn't looked into it, I'm just going to give you the top line. Home appreciation outpaces inflation over the long run. Okay, that's why you have home appreciation is 3%, which is a full 50% higher, right? 1% higher, which is a 50% increase over the expenses inflation. This is pretty standard. We all know the Fed likes to try and target, that's their term, target a 2% inflation rate. They rarely, if ever, achieve an actual 2% rate for any extended period of time. It's, for a long time in the 20 teens and whatever, from about 2014 all the way to 2020, we were experiencing very low inflation, right? I think we were below 2% for a lot of that time nationally. But again, there's also going to be periods of high inflation, which we've also seen recently, right? But the key here is that your appreciation is generally going to be higher than your expense inflation. So I use an expense growth rate of 2% as an average. It might be a little higher than that, but I find that gives me a pretty good estimate of where that's going to be. Things like, and this is going to affect all of our expenses, such as taxes, insurance, reserves, HOA, maintenance. The taxes, if you're not too familiar with that, taxes generally have a cap in most states for how much they increase year over year. So that's why a lot of times you'll see homes that were built in maybe the 80s or 90s, a long time ago, decades ago, their tax rate, not really the rate, but the amount of taxes that somebody's paying on a home that they've owned for over a decade is going to be lower than if you go and buy that home today and pay the stepped up tax basis on it, right? That's just the way it works. Most people that have bought a home have seen that happen firsthand, especially investors, because we tend to pay attention to these things. You probably noticed that the previous owner of a home you bought was only paying maybe $2,000 a year in taxes. And then as soon as you bought it, that skyrocketed up to $3,000 or $3,500 a year, right? Or whatever it might be. In Texas, I know taxes are much higher. I've also invested in Texas previously, so I'm a little familiar with Texas markets. So obviously Texas has higher property taxes. There's places like where I live now. Wyoming has very low property taxes, also has no state income tax. Wyoming is a great state for taxes. So, in Wyoming, our tax rate is probably going to be a good bit lower than what you see in a lot of other states. So you want to basically kind of figure out your taxes down here in the base monthly expenses. We'll go over this in just a second, but I just wanted to point out that the growth rate for your expenses is generally going to be lower because of things like that, where taxes are capped. Insurance, you're generally just going to have increases in that. There's not a whole lot you can do. I mean, you can shop around for cheaper insurance, right? But I think that generally stays about the same. Reserves, that can change over time, so be aware of that. In this workbook, it won't. It's just going to be a flat 2% or whatever percentage you put in here increase each year. But reserves, typically, if you don't use a lot of your reserves in, let's say, the first couple years, you're still going to have that money left for reserves going forward, right? So there is a possibility that you may not need as high reserves as you originally think if things hold up better over time. There's also the inverse of that, right? You could have higher reserve needs than what you originally thought you would if, let's say, tenants are just really hard on your appliances and you have to replace appliances sooner than you thought or whatever, right? HOA, in my experience, HOAs don't go up that much. I mean, they do increase over time, but they're usually less than the inflation rate of inflation or equal to the rate of inflation. So, those might be lower than what your general inflation rate is or whatever. Overall, my point here is that your expense growth rate is typically going to be a little bit less than what you're seeing for like appreciation and rent growth. Okay. So let's talk about the expenses real quick. Here at the bottom, we have our expense table. You can see right here. This is going to outline for each individual property. And because this is a never sell portfolio planner, obviously the never sell strategy is based around 15 properties. So that's what this has available in here for lines. We got 15 homes here that we can input expenses for. I want to make a note here that these values that you see in this table right here are all going to be your year one value. Okay. Whatever the value, whatever the taxes, insurance, maintenance, and reserves, whatever all of that is today, essentially in year one, you want to enter those values here, and then it will automatically have that 2% per year growth rate applied to it when we go to the tables page. So for our expenses table, you have your taxes. These are monthly amounts, as it says right here, base monthly expenses. So you're going to want to take your annual taxes, divide by 12, and that's the number you're going to put in here. Insurance, again, typically that's going to be kind of an annual number. So if you have it as an annual number, just divide by 12 and put that number in here. If you know what your monthly is, maybe you see it on your mortgage statement or whatever, then you can put that monthly amount in here. Maintenance, this is going to be just general maintenance items, not CapEx. In this case, with this example, a lot of these homes are new builds from Alex's story in the book. The first three were not, but then after he did the first three houses, the rest of them were all new construction, because that in the story, that's how he got the best discount on purchase or on acquiring these rentals. HOA, or sorry, reserves was next. So here we have our reserve amount. $100 is probably a little bit low. Honestly, it just depends. The reserves can really depend on a lot. I'll show you guys real quick the reserves calculator that I have. I'm going to make a whole nother video about that and going over the reserves calculator. If you want to use that, it's a really good tool for figuring out what you actually need for your monthly reserve contributions if you're doing it on a monthly basis, right? If you front load your reserves, there's also an option for that. I like to basically set aside reserve money at acquisition, not the full amount, obviously. I'm not gonna, like, if I'm doing a 15-year term on a loan, so that means I have 15 years, I'm planning to hold it for the full term. I have 15 years I need to worry about reserves for, right? And then at the end of that 15 years, you're either going to refinance the property, sell it, or something, where you're pulling out a bunch of cash again. From that pile of cash, you're going to want to set aside some reserves again. But that's why I only go out 15 years typically if I'm doing a 15-year mortgage. If you're doing a 30-year mortgage and you're planning on holding it for the full 30 years, you probably want to plan your reserves over a 30-year timeline, right? I'll go into a lot more detail with the reserves in the video where I talk about the reserves calculator, but for now, I think that's a good basis. HOA, in the story, Alex was buying in an older neighborhood, established, did not have an HOA, so there's no HOA fee there. If you do have an HOA fee, make sure you include that there. You definitely don't want to forget about that. There are some areas where HOAs can be extremely expensive. So, that could be a big chunk of your monthly expenses. Definitely don't want to miss that. Okay. So that covers our expense table down here. And then we come to basically the full, the table of all the information on the acquisitions. Okay. Acquisitions and refis. So again, we're just ordering it by the house number. I'm going to center these, makes it a little easier to see. So house 1, right, is going to be this top row all the way across. House 2 is going to be the next row all the way across, and so on, right? So house 1, acquisition method, is going to be our first column here. I guess technically second column if this is our first column. But in any case, acquisition method, you can just type in whatever it is here. It doesn't really affect. I thought about making this a drop-down menu, but honestly, you can type in whatever you want for if it's buy, burr, build, flip. Well, I guess you wouldn't do a flip for a long-term hold strategy like this is built for. But my point being, you could type in anything, right? Just the point of this is just to identify what the acquisition method for that home was, because that could be important for your planning. Depends. Acquisition year, this is going to be the year that you acquired the property in. Following Alex's story from the Never Sell book, he acquired one property per year for the first 4 years, right? So property 1 is year 1, property 2 is year 2, property 3 is year 3, property 4 is year 4. In year 5, he started doing he did 2 houses for year 5, and then after year 5, it was 3 houses per year to finish off the portfolio, right? So year 5, you can see we have both house 5 and 6 are in year 5, and then house 7, 8, and 9 are all going to be year 6. House 10, 11, and 12, year 7, and then the remaining 3 houses are all in year 8. So I think that's pretty straightforward, easy to understand. Purchase price. This is going to be what your actual cost was, not out of pocket. This is including your financing. So whatever the total acquisition cost was before financing, this is what you're putting in right here. This is not super important other than just for determining what your kind of what your cash on cash is and those sort of things, right? But yeah, that's what the purchase price is. And then you have initial value. Okay, so this is the actual market value at the time of acquisition. So in this case, you'll see Alex bought his first house. It was just a standard buy and hold turnkey property, right? He actually spent $308,000 on it because you got closing costs and whatnot in there. But the value of it was only $300K. So he spent more than what the actual value of the home was. That's pretty typical when you're buying turnkey, just because you're going to have some, like I said, closing costs and possibly some other additional costs in there as well, right? So initial value, again, this is just going to be your market value. Following Alex's story, the first 3 were all $300,000 initial value. To keep it simple in the story, I just left them all the same, even though each year it's probable if these were the exact same home, this would have appreciated by 3% per year. But they're not each the same home. 2 of them were burrs, 1 of them was a turnkey, whatever. To keep it simple, I just left each one at a flat $300,000 initial value. And then we come to base rent. So the rent, you can see, did go up year over year. I think that's how I did it in the book. I can't remember for sure now. But anyways, yeah, pretty sure. So we had $2,500 was our starting base rent for these rental homes. And then each year that increased a little bit more with the 3% rent growth rate, right? Essentially. But the numbers that you're putting in this table, unlike the expenses table, the numbers you're putting in this table, all these numbers need to be exactly what they are at the time of acquisition. So if you're acquiring, let's say, house number 6, you're acquiring it in year 5, that base rent that you enter right here should be what the base rent is for year 5. Okay. An easy way to do that, if you don't want to do the math and put each, in this case, I put each of these numbers in individually because I was copying it from the book, or rather from the original set of tables that I had created for the book. What you can do is just come in here. You can do like an equals that cell and then times 1.03, or you could even do 1 plus your appreciation rate up here, which is 3%. So I could just type in 1.03. It's going to do the same thing. We hit enter and it gives us the same number there, right? And then you could just drag that formula down through the whole column, and it will automatically increase year over year by that 3% rent growth rate for each year, assuming each of these homes was purchased in another year. In this case, we had groups of homes that were purchased in the same year, so you'll see that the number is the same for any of the homes that were purchased within the same year. The next column, term. So this is your loan term, right? In the book, in Alex's story, he bought the first 3 properties on 30-year mortgages, which is what most investors use. It's a great mortgage for investing. It allows for a healthy amount of cash flow, and it's pretty standard loan, so it's easy to qualify for in most cases. In the story, when Alex switched to his build to rents, he did switch to doing a 15-year loan because he was getting a much larger discount on the acquisition of those homes because he was self-GCing the builds himself, which saves him, in most markets, that's probably going to save you anywhere from 10 to 20% off the cost of that home, depending on what the builder's margin is in your market. In my market, it's 20% plus. I know like in Texas, it tended to be about 10 to 15%, depending on the size of the home, right? Bigger homes usually had a little bit higher builder's margin to them because there's more risk involved. It's a longer timeline, things like that, right? If you're just building these simple little rentals, I think in Texas, 10 to 12% GC fee is pretty typical. GC fee, same thing as builder's margin. So anyways, but he did switch to the 15-year term for the loans, which is what the Never Sell book is all about. It's about keeping your retirement portfolio, right, which is separate from the rest of your investment portfolio. But your retirement portfolio, what you have planned for your actual retirement, the whole idea is to have those on 15-year mortgages. That's why we have 15 houses. One will pay off its mortgage every single year for the rest of your life. If you're not familiar with the plan, you can watch my other video about it or go read the book. The book is long. I covered a lot of information because I wanted to make sure I covered everything for people that were not super experienced or into real estate investing yet. Maybe somebody that's just getting into it. I wanted to make sure I covered all the bases in the book. So there's a lot of information in that book, but I do tie pretty much every single chapter in that book specifically to this strategy and why it's important for this strategy. So anyways, just wanted to mention a quick note about that. Interest rate. Again, in the book, Alex was getting a 6% rate on his 30-year mortgages and then a 5% rate on his 15-year mortgages. That's not unusual. You can usually a 15 to a 30-year mortgage, the difference is going to be around 0.5% to 1%, right? With the 15-year mortgage being lower interest rate than the 30-year mortgage. In this case, I took that to the extreme, just went 1% because I wanted to keep it simple. You could make these 5.5% for 15-year mortgage and 6% on 30-year. Today, with actual rates today, I could get a 15-year DSCR loan with like a 60% LTV, 70% LTV. I could get that at about a 6% rate, which is basically the same as what an owner-occupied 30-year Fannie Freddie mortgage is, right? Investor loans right now, if you're doing an investor mortgage at a 30-year term, you're probably looking at about 6.5 to 6.75 for your rate. Today, I haven't checked recently because I'm not paying that close attention to the 30-year loans. My main concern is 15-year mortgages, but I think that's about where it is today. So you can kind of see what the difference is there. If you were doing a 30-year DSCR, you would probably even be a little bit higher than that. Although I think right now DSCRs are pretty close to what standard mortgages are as far as rate for investor mortgages, right? Rental mortgages. Yeah, so that's the rate. LTV, this is where you're just going to put in what your loan to value is on that home. So like in this example, the first turnkey buy and hold was an 80% LTV. Basically, this was Alex's first dip into real estate investing. He just bought a turnkey home with 20% down, 30-year mortgage. Pretty standard numbers. This is how a lot of people get started in investing. Their first home is typically bought this way. So went ahead and used that for the story. 80% LTV there, and then 75% LTV on all the rest. Just, as an investor, most investors tend to figure out pretty quick that having a lower LTV can be beneficial to a point. There's probably diminishing returns in there, whatever, but most investors I know like to be around that 70 to 75% LTV on their investments if they can. Of course, that all depends on the capital that you have, how much money you have to leave in the deal itself. And there are periods of time, even when lending is a little bit tighter, when 75% LTV is the best you can get. You won't even be able to get an 80% LTV on a non-owner occupied home. In other words, an investment property. So 75 is a really good number to start with. I just used 80 for the first property because that's what we went with in the book for Alex's story. So the loan amount, all the green text is going to be automatically calculated. So you don't have to input anything for any of these green numbers. Okay. So the loan amount is automatically calculated based on the LTV and the initial value. Okay. Not the purchase price. It's calculated off of the initial value, because that's how loans work. If you're not familiar, you'll get an appraisal on your property. They'll tell you what the market value is. And then a bank will say, okay, we'll give you 75, 80% of that value for a mortgage. So this tells you what your mortgage is, what your loan amount is, loan balance, starting out. Then we get into the refis, right? This is gonna be your first refi and second refi. Obviously these tables go out to like year 40, and then some of the tables for the refis actually go all the way out to year 50. Just for calculation purposes. So you're going to have multiple refis if you're doing the 15-year term like the book teaches, okay? So in this case, refi starts on year 9, 10, 11, 19, 12. This is following exactly what was in the book. The reason it jumps around a little bit, like from, for example, house number 4 doesn't get refinanced until year 19, whereas these other ones, excuse me, these other ones are getting refinanced much sooner. If you read the book, read the story, you'll understand why. Basically, it's just because of the way he acquired, because Alex had some 30-year terms for these first 3 loans. And then because he was building multiple houses a year after that, the refinance schedule didn't quite work out to where, it was a perfect chronological order based on when the property was acquired. He had to do some creative work there, and I'll kind of detail that a little bit more on the tables page. But that's why these numbers kind of jump around a little bit. It just depends on what your structure is with your properties. If you're just acquiring one property per year, like the base never sell strategy recommends, one per year for 15 years, these refi years are just going to go, 16, 17, 18, 19, 20, and so on. They'll just go in order. But basically that's what that is. Your refi LTV is right here. Again, just sticking with the 75%. Refi rate, we dropped it to a 5%, or not dropped, but I mean, we stuck with the 5% rate that he was getting back here. Again, I'm just trying to stick with averages for the story in the book. I didn't want to stay specific to what today's market is, because the markets are always changing. These numbers are always changing. So I tried to stick with what historical averages were on a 15-year, in DSCR loan, for example, or a 15-year mortgage in general. Your interest rate is going to average over long term around 5%. It differs a little bit. I think the actual average over time, over like 30 years, has been around 5.1, 5.2%. You do, of course, always have the option to buy down that rate a little bit as well, depending on what the rate floor is. But yeah, 5% is historically a pretty good average for 15-year term loans. So that's kind of what I stuck with there. Again, your term for the refinance is right here. In this case, they are all going to be 15-year terms. And then we go to refi number 2, the exact same information, what year the refi takes place in, which is just going to be this year plus 15, basically. If these are all 15-year mortgages and your plan is not to refi again until they're paid off, then You're just going to take this year plus 15 is going to give you this year, right? So we have all of our refi number 2 years put in. Again, refi number 2 LTV. This time for refi number 2, we're dropping down to a 70% LTV. I talk about this in the book. As you start getting into your refinances down the road with the never sell portfolio, you may want to actually reduce your LTV just to be a little more conservative and safer. You don't have to. It honestly all depends on what your margin is for cash flow, right? If a 70% or if a 75% LTV only leaves you with like $100 a month cash flow, then obviously you want to reduce that LTV if you can't do anything to reduce the interest rate, right? Those are kind of the two levers you have. It's either LTV or interest rate. So reducing LTV can give you a better cash flow, right? Now, obviously that means if it's in the acquisition phase, you gotta have more money down. But these refinances here, because this is our second refinance, and even after the first one, you know, these are refinances on paid off homes. So you can really refi at whatever amount you want. You're just pulling all that cash out of the home. So the difference between a 70 and 75% LTV in the grand scheme of things, I mean, if you're pulling out 250K in cash from a paid off home with a finance, is it really gonna matter if it's 230K or 250K, right? You leave whatever you need to in the property as far as capital goes by lowering your LTV in order to get the cash flow that you need to keep that investment safe, right? You want to have a nice cushion of cash flow above what your expenses and everything are. Okay, and then again, refi interest rate, we just went 5% again. Like I said, historical average. I'll just stick with that for forecasting, especially when you're forecasting 24 years out into the future. Who knows where rates will be? Maybe we'll be back down to like 4% rates. Maybe we'll be still at 6%. Maybe we'll be higher at 7% or something like that, right? There's no way to know for sure when you're looking at, you know, a couple decades out into the future. So I stick with the 5%. Again, at this point, the homes are paid off if you're using the never sell strategy. So really, even if this rate is 8%, let's say, you could still lower your LTV to like a 60% or a 55% LTV, whatever that rate allows you to do an LTV at in order to cash flow the property, right? And again, refi term 15 years. These are all the calculations based on that number. You can see the balance at refi number 2 is 0 right across the board. Like I was saying, it's a paid off home every single year. So that's the benefit of that. I guess I'll run through these real quick. So you got your value at refi number 1. That's what the home value, the market value is. You have your loan at refi 1. This is what the loan is based on this value, right? And then the LTV that you selected. Balance at refi number 1. This is the balance of the existing mortgage. So you can see some of these, for example, this 30-year term loan on house number 1 obviously was not paid off by year number 9. So in year number 9, the amount of balance left on that 30-year loan, 30-year mortgage was $210,000, right? Out of the initial $240,000. So you can see over 9 years, you only paid down $30,000 of that loan, basically. And that's where the real power of the 15-year mortgage lies. You are paying that balance down so much faster that the gain in equity actually, well, I don't want to say always, but it will actually, in most cases, outpace the cash flow that you would have gotten by using a 30-year mortgage. Most people are so concerned about cash flow when cash flow is really just a safety net. It's a buffer for when things aren't going quite according to plan, right? You want to have maybe $250, $300,000 or $300 a month in excess cash flow off the property in case rents go down or expenses increase more than you expected, things like that, right? So it's pretty important to have a certain level of cash flow, but beyond that, you get much more value out of principal pay down, in my opinion. So that's something, I mean, that's why we go with the 15-year term with the never sell strategy. Principal pay down is basically the primary benefit that we're targeting with this strategy. Let's see, so balance at refi 1 and then your cash out. This is When you pay off this balance with this new loan, this is going to be the amount of money that you get cash out from that finance, right? Obviously, these are cash out refinances. These are not going to be just rate and term. So you are getting that money out. That is kind of the whole point of the never sell strategy, is to access your wealth through tax-free financing by pulling equity out of paid off homes, or in this case, partially paid off homes. But ultimately, the goal is to get to all paid off homes, as you can see right here. So refinance 2, same information. You got your value at refi 2, loan at refi 2, and then your loan balance at refi number 2, which in this case, by the time we get to refi number 2, all of these were 15-year mortgages at this point. So all of the second refis are going to have a 0 balance, which means you are pulling out the entire, LTV amount of that home. So if the home if you're doing a 70% LTV on a home that is valued at $592,000, you're able to pull out $414,000 tax-free in cash to use for whatever you need, right? Because that mortgage will continue to be paid down by your tenants' rent payments. So anyways, and then we get to refi number 3 here at the end. Originally I had this table made with, or this worksheet made with just 2 refis, and then I added the third refi because there were some scenarios where, let's say you want to model out an existing portfolio where all of these homes are already acquired. So technically you would just put all of these as acquisitions in year 1. And so in that case, you would definitely want to see a third refi when we go to the tables, when you're planning, 30, 40 years out. So refi number 3, I added this on later on. It's just the exact same information as the other 2 refis, all right there. So I'm not going to go through that in any detail. So that covers the inputs page. Hopefully that's all super clear. Like I said before, the only stuff you need to change to put your information in is anything in blue, okay? The green stuff, leave it exactly as it is. Those are calculated cells based on the inputs. Okay, let's go to the tables tab and we'll take a look at that real quick. Oh, wow. Okay, this recording is going a little longer than I thought. Sorry. Once I start talking about this stuff, it always goes much longer than what I expect. I try to keep my videos around 30 minutes, 30 to 40 minutes, and they often go to about an hour. Hopefully you guys don't mind. So anyways, as you can see right here, this is our the total income table. This basically is your overview table. Okay, this is going to show you everything that's happening over the long term of the plan. So we have our years over here on the left column. Like I said before, it goes all the way to year 40 at the bottom. And then we have each of our houses, house 1 through 15 right there. And what you see below each house, based on what year it is in, is the acquisition. So this is where that acquisition method is going to show up. It'll show you whether you bought, bird, build, whatever. So you can see exactly where all your acquisitions happen. In this case, they happen in the first 8 years, right? We have 1 in year 1, 1 in year 2, 1 in year 3, 1 in year 4, 2 in year 5, and 2 in year 5, 3 in each year after that until we get to year 8, and then the full 15 property never sell portfolio is complete. Now down here at the end, we're gonna have cash out from refis. Okay, this is your refinancing cash out. This is your cash flow. Okay, this is an annual cash flow. So taking the monthly cash flow multiplied by 12 gives you this number, right? And then your total is going to be the refi amount plus your annual cash flow. Okay, so you add these 2 columns together and it gives you this column with the totals. And then just because I like to sometimes see things on a monthly basis, you can see what the monthly, basically what this total amount is divided by 12 for 12 months gives you your monthly amount right there. Okay. And again, that is refinance amount plus cash flow, all combined into that one number. Now, also out here in the main body of the table here, you're going to see all these random numbers. Well, they look random because in this case, they're kind of staggered around in here. If you're doing, you'll see when I show you the next example, depending on how you say, if you just set up 1 acquisition per year all in a row, then these numbers are all just going to go diagonally straight across, and then you'll have another row diagonally straight across here. You'll see what that looks like in a minute. But these ones are jumping around just because of the way that these properties were acquired and then refinanced in order to get them into the 15 property, the never sell cycle, right? So that you could get one payoff or one paid off home to refinance every single year perpetually. right? Until you die and even beyond when you die. So that's what all these numbers here is. It's just showing what the refi amount is, and then that number gets dragged over to this column to give you your refi for that year, and then add it into everything else. So this table here is going to be populated based on, and again, there's no inputs, nothing that you need to change on this page. All the inputs are going to be right here on the inputs page. But if you scroll over a little bit, we'll get to, let me, wonder if I zoom out just a little bit. I think you can still see all the numbers. Okay, oh, it wasn't quite enough. I want to try and get all three. So here we go. So I got 3 tables across, right, horizontally. And then, so it's 3 per row, and then we got 5 rows to give us all 15 homes here, okay? Hopefully that makes sense. I kind of set this up the way that I'm used to, but I understand everybody kind of has their own way of organizing spreadsheets and whatever. But anyway, so we got house number 1 table right there, and these are the acquisition numbers, okay? These are all the numbers from acquisition. 1, 2, house number 3, house number 4 down here, house number 5, house number 6, and so on and so on, okay? What you're gonna see, let me zoom back in a little bit so it's easier for you guys to see. In these tables, at the top of each one, it's gonna say what house number it is, okay? So house 1, house 2, house 3, so on, so on. You got your year, obviously, in the first column there. We have our cost. No, I don't want to do that. We have our cost in whatever year it was acquired, right? So house number 1 acquired in year 1 at a cost of 308. House number 2 acquired in year 2 at a cost of 255. House number 3 acquired in year 3 at a cost of 220. Okay, so now our loan balance is going to come from the inputs as well. That's going to be your LTV times your market value, not the cost, but the market value. Which is also identified right here. So we have our values here, and then you have your loan balance. You can see the loan is getting paid down every year, so your balance is going down until it reaches 0, in this case after 30 years, because it was a 30-year term on that mortgage. If we scroll down here and take a look at a 15-year term, you can see that the loan is paid down all the way to 0 in just 15 years, right? And exactly as it should be. It's kind of funny, it shows zeros there, but then no zeros down here. I do remember messing with that a little bit. I guess I just didn't get it all to be the same. Not that it matters. These dash marks are actually identifying as 0. It's just they're showing as a dash instead of a 0. But 0 or a dash, they're all zeros. So that doesn't really matter. Anyways, continuing through what these columns are. So you got your value, then your LTV. This is going to show you. So basically the refinance happens when the home gets completely paid off, right? In this case, if you come up here to the 30-year, we refinanced this one in year number 9. This all comes from the inputs page, right? Where you're putting in what the refinance year is. It's going to go ahead and identify what your LTV is. It's going to show LTV 75 or, LTV, whatever it is that you put for the LTV here is going to show up there in the column header. So in this case, that it was a 75% LTV. That's what the loan is going to be based on that value in that year, right? So in year 9, this home went from $300,000 value to $380,000 value based on the 3% appreciation rate. So our LTV at a 75% LTV, our loan is going to be $285,000 balance. And that means when we pay off the initial loan, because our loan balance over here on the acquisition loan is only $210,000, we get $285,000 from the new refi. So that means we're getting almost $75,000 cash out from that refi. Okay, so that's what the cash out column is. It's showing you what your cash out from the refi is. Then we have our mortgage expenses, income. This is your rent, right? So mortgage, obviously, that's your monthly mortgage payment based on, in this case, what this loan is, the acquisition loan. You can see it keeps the acquisition loan all the way through. That's because these are just the acquisition tables. These are not the tables used for the refi information. So it does show you when the refi is, but it doesn't actually change these numbers based on the refi. This is just to show you, like if you're curious, if I don't refi and I keep this loan all the way to term, what's my cash flow going to look like in year 28, for example? And so you can see here, you go from under $500 a month cash flow to over $3,000 a month cash flow if you just keep this loan, the 30-year mortgage on it for the full 30-year term, right? You can see exactly what your cash flow is. So that's why I left it like this. The refinance tables are going to be further over here. Okay, we'll go over that in just a minute, but you can see in the refinance tables, it does show you what your payment changes to with the refinance. Okay, we'll go over that in more detail in just a second though. I want to finish this first. So expenses, again, this is taking your expenses, year one expenses from your input table back here on the inputs tab. And then it's just growing those expenses by whatever the inflation rate that you put in the inputs table or page was, right? So in this case, it's increasing 2% per year. Our income, this is going to be what your rent is, the gross rent. In this case, gross rent started out at $2,500 a month. And then of course it's growing at the 3% rate after that, because we set 3% as our rent growth rate back here on the inputs tab. So you can see that's automatically calculated all the way down with that rental increase rate. And then your cash flow is obviously just going to be your income minus your mortgage and expenses. Okay. So pretty straightforward. I think most of us know how to calculate cash flow. That's all this column is right here. And then your annual, this is monthly, annual cash flow. Excuse me. Annual cash flow shows up right here in the last column if you'd like to see what the annual amount is there. So again, house 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, and 15 are all identified in their own table right here with their numbers at acquisition. Okay. And then identifying when the refinance happens and what the value of that refinance is. Now, that's when this table is going to, so once it gets to that refi, it's going to stop taking numbers from this table and it's going to start taking numbers from the refinance tables after the properties have been refinanced, right? Makes sense. So here, the refinance tables go all the way out to year 50. Just so we can see long-term what's happening with these loans. There will, like, let's say you're doing 30-year mortgages on all these, you could, right? If you want to see what that looks like, and you'll be able to see all the way out to year 50 here. Basically the same information, a little bit less information though. So we have refi amount. This is what we're, the cash that we're pulling out on refi and what the refinance loan balance is, right? Same thing. The cash you're getting out because they're paid off homes. Well, not always. In this case, this first home was refinanced, not as a fully paid off home. But anyway, so this is your new loan balance. Basically, the refi amount is how much the new loan is for. You do have your home value here again, starting at your 300K or whatever your initial value in year one is, and then appreciating year over year as you go down the column. Mortgage, that's your mortgage payment based on whatever the loan is at that time. So you can see for the first 8 years here, we had $1,400 a month for a mortgage payment because it was a 30-year term on that mortgage. Then in year 9, we refi, right? Pull out that 75K, but we do it on a 15-year mortgage this time. So now with that 15-year mortgage, your monthly payment jumps about $600. Well, in this case, $800 higher. Okay. Usually it's around $600 to $800. Depends what your price range is. But anyways, so yeah, that jumped us up to a higher monthly payment. And then when we do the next refi here, obviously refinance means new monthly payment based on that new loan. So here again, the monthly payment jumps up. And then again with refinance number 3, the monthly payment jumps up to whatever that would be based on the LTV interest rate and everything that you put in the inputs page. Expenses here just stay the same, you know, just increasing at that 2% annually all the way down. Your income, your rent is again start at your starting value and then just appreciating 3% a year from there on, or inflating 3% a year, whatever you want to say. Appreciate, inflate, same thing in my mind. I know they're not really, but anyways, cash flow, again, here, the cash flow is just taking your income minus your mortgage and expenses. So you can see here when we get the more expensive mortgage in year number 9, we go from almost $1,000 a month cash flow and we drop that all the way back down to $200 a month cash flow. But we did get the $75,000 tax free from the refi. So if you divide 75,000 out, I'm not going to attempt to do that in my head real quick because I might say the wrong thing. So what was I doing? Divided by 12. I wanted to see what the monthly is for that. So you're gaining an extra $6,000 a month by refinancing that property instead of just collecting the cash flow from it for that year. Okay. That's why the never sell strategy focuses so heavily on financing and using 15-year terms. Hopefully this spreadsheet can help you kind of wrap your head around the math of this. I know a lot of people like to do comparisons. They want to compare, well, 30-year loans versus 15-year loans, or paid off home versus financed home. What's going to give me the best returns in the long run, right? Overall returns and that sort of stuff. Something I don't have calculated in this table is your tax benefits. Obviously, that refi is completely tax-free, right? So you're not paying taxes on that. If instead you just continue collecting $1,000 a month cash flow for year number 18 or whatever, yeah, you could collect back here, for year number 8, let's say year number 9, if you just collect $1,000 a month cash flow, you're getting an extra 12 grand, right? For the whole year. It's $1,000 a month. Or you can refi it, pull out your cash, your equity as cash, up to that 75. I think we were doing 75 or 70%. I don't remember what we did for the refi, the first refi, but 70 or 75% LTV. So you're taking out that equity up to that limit in cash. You're gaining 6 grand a month from that refi. And then the following year, guess what? You get to do it again on house number 2. You get to pull out all that equity that you've built up in house number 2 as cash. You're going to get even more than that $6,000 a month, $6,500 a month, $7,000 a month, whatever it turns out to be, right? So that's why this strategy uses financing rather than just relying on cash flow from 30-year mortgages or even paid off homes. Even if that home was fully paid off, I should do a whole separate video on that, honestly. I'm not gonna have time to talk about that in this video. But I'll probably do a separate video where we look at the difference between a portfolio of 15 paid off homes and just cash flowing those, and then a portfolio of 15 homes that are continuously financing, right? Every year, another refi on a paid off home. And we'll take a look at what the differences are in income, especially when you account for taxes, okay? Because if let's say you're making $300,000 a year, right, from maybe a W-2 plus all your cash flow from your 15 properties, you'll be paying what, 25% tax rate on that, and that's assuming you don't. Let's say you have state taxes too, state and local. You're going to be paying maybe 30% taxes on that cash flow coming off that property, because by the time you have those homes paid off and you're just collecting nothing but pure cash flow off of them, minus your expenses, of course. That cash flow, you no longer have, let's say, depreciation to count against that income, right? I mean, you used up your depreciation already. Most people like to do accelerated depreciation. So you used up all that in that case, you would have used up all that depreciation a long time ago. So you're paying full taxes essentially on that cash flow, right? And now there are still some deductions you can take and whatever, but just to keep it simple, to make my point, you can either take that cash in a loan, pulling from equity, getting the $6,000, $7,000, $8,000 a month, essentially, even though it's all in one lump sum for the year. And you're not paying any taxes on that. Or you could be getting your $3,000 a month cash flow from a paid off, and it'd be like $2,500 a month because you do have to subtract out your expenses. You could be getting $2,500 a month cash flow off that paid off home, but then you're paying 25 or 30% taxes on that as well, right? So let's say it is $3,000, you're paying 30% taxes. You're actually only getting $2,000 of cash flow out of that home then, right? After you pay your income taxes. So that's why I try to explain. It's hard for people to grasp and wrap their head around in the beginning, why it's better to do this than just cash flow paid off homes. So I will do a whole separate video on that because it is worth diving into. That is kind of the basis of this strategy, is maximizing your capital efficiency is what I would call it, right? How you're maximizing the returns that you're getting by accounting for all the different expenses, including income taxes, your personal taxes, right? Anyways, just about done. So let me finish running through this real quick. So you got your income, you got your cash flow, just like before, and then your annual cash flow. And again, we have refinances set up for all 15 properties as individual tables. So if you want to see what any one specific property is going to be doing, you can look at that. But all of this information wraps right back into the main overview table, the total income table right here at the front. Right, that's where all these numbers are using. Not just it uses the acquisitions until you have a refi, then it switches to the refi numbers based on which refi it is. So refi number 1, refi number 2, refi number 3, it's going to pull the appropriate numbers depending on which refi it is. And that's kind of the whole point of this, is where you can just plug in whatever numbers you have for the inputs page, and then all of this is going to automatically populate and show you exactly what your plan looks like over the long term. Okay. So now, real quick, I'm so close to an hour long on this video already. I'm going to show you real quick a couple other examples of tables here. So let's just minimize this one. We don't need the calculator up anymore. So this one right here, I changed the numbers around. This is basically doing a 1 per year build to rent style, right? These numbers are based on Texas numbers. In particular, I got these from another investor on YouTube who does build to rent in Dallas, Fort Worth area. He's actually in Fort Worth. But he made a video about his numbers, and I was watching it recently, and I thought to myself, well, what if I plug those numbers into my table and see what it does? Now, he is actually building, he's using a GC for his build to rents. So he is paying an extra 15-ish thousand to his GC. If you guys know me at all, I like to self GC. A lot of people are afraid to self GC. They think it's a ton of work or whatever. And yeah, if you've never done it before, the first time it is going to be a lot of work. But once you learn the process and you have your systems down, being a GC for a new construction build, just one build at a time, is actually like a side gig. It's part-time work. I mean, you would spend maybe a couple hours a day at most general contracting that build, right? Once you have your systems in place and you understand what you're doing. Like I said, your first one that you ever do, that you ever general contract yourself or self-build, is going to be different. It's going to take it's got a steep learning curve, right? And so you're going to be learning a ton. You're going to be doing a ton of research, making a bunch of calls. But after the first 1, 2, maybe even 3 houses that you build, it becomes so easy to do. You could literally do it in your sleep. I know plenty of builders that can GC a build with just maybe a couple hours a week of time input. Okay. So that's something a lot of people get scared off by the idea of self GCing build to rents. It's really not. Remember, these rentals you're building are not luxury custom homes. They're boxes. They're basically what I call people boxes. They're just a rectangle with a roof and a few bedrooms, 2 bathrooms, maybe a garage on the side. They are extremely simple and easy builds. So if you're going to self GC something, that's what you want to self GC. You don't want to be doing these luxury spec homes or high-end homes, you know, $1 million homes where you got all these luxury finishes and complex designs. Yeah, I don't recommend that most people self GC those kind of builds. But when you're doing a simple little box with a roof as a rental, it's actually very easy to self GC. So I went ahead, built this out as a self GC model. So he was actually building them for a little over $200,000 total cost. And he was getting an appraised value at the end for around $270,000, right? So I went ahead and plugged those numbers in, but I dropped the purchase price based on my model, which is self GC. I took about $15,000 off because I assume that's about how much the GC for his projects, the investor I was watching, I assume that's about how much he would be paying a GC to build those for him in his market, right? In that Dallas Fort Worth area. The rent is exactly what he got for rent on his builds, $2,100 a month. Now he was doing 30-year terms. This is where I changed it to the never sell strategy, basically using the 15-year terms right from the start, right off the bat. But yeah, these are real numbers basically from an investor that's doing this today. I mean, the build that I took these numbers off of, he did within the last year. Okay. I think like 6 months ago, or maybe less than that even. It may have just been a couple months ago. I don't remember. But anyways, it was within the last year. These are current numbers from a real investor. The only change that I really made to his numbers was making it a self GC project instead of hiring a general contractor. And that just reduced the purchase price, you know, the cost to you by about $15,000. I am doing 15-year term. I went ahead and did 6% rate because that's what we were working with today. And I wanted to, because these numbers are current, you know, current numbers that investors are currently getting, I wanted to go with what current rates are. Like I said, currently today, I can get a 15-year DSCR mortgage on an investment property with a 6% rate. Basically, that does involve a little bit of buy down on the rate. I think you end up spending a couple $1,000s at closing for buy down. I also include that in the purchase price. In this case, I always wrap any closing costs or rate buy downs, things like that. I just wrap them into the purchase. That, to me, that's part of your total cost to acquire, right? So when I say purchase price, that includes closing costs, all those kind of things. So yeah, 6% rate. So at that interest rate and with these numbers, A 60% LTV is what made the most sense to me for an acceptable level of cash flow, right? Monthly cash flow to work with this 15-year mortgage. So at a 60% LTV with a $270,000 value, that is leaving you with a $162,000 loan. Simple enough, right? And like I said before, this is just doing one per year for 15 years. So our refis are happening one per year, all in a row, right? 16, 17, 18, 19, 20, 20. Like I was saying, just one after another. Each year, it's the next one refinances because it got paid off. Now on the refi, we are doing a 70% LTV because of appreciation, because of rent increases, and maybe some efficiencies and expenses. A lot of investors over time find some efficiencies there where they can possibly even keep their expenses the same or reduce a little bit. In this case, it's just going to have the flat 2% annual growth rate for our expenses across the board, but that is always a possibility. In any case, in this scenario, it made sense to actually bump that up to a 70% LTV by year 16 with the new 15-year mortgage that we're placing on these with refi, right? Still sticking with that 6% rate, even though 15 years from now, I doubt rates are still going to be right at 6%. Sure, it's possible, but they'll probably be different. Could be lower, could even be higher, right? Who knows? But we'll stick with the 6% from today's rates for that, just for consistency's sake. Year two the refi two, again, the years just all in order chronologically: 31, 32, 33, 34, and so on. Again, 70% LTV, 6% interest rate, 15-year term. Same thing with the refi number three. Oh, and something I didn't mention before, these refi number three numbers, these actually do have calculations in them, formulas in these cells. You can put in your own numbers for these if you want, but I do have it set up to automatically calculate 15 years. The refi years can be whatever refi number 2 year was plus 15. And then I just set these numbers, the interest rate and the LTV, to be exactly the same as what these ones were for refi number 2. Same thing with the term. It's going to be a 15-year term again, just like number 2. So these are set up to automatically populate. But if you want to use different numbers for refi number 3, you can just change these blue cells to whatever you want, right? As far as expenses, again, I was using the expenses from the investor that I was watching the video from, where he was going over all of his numbers for his build to rent. So his expenses in the Dallas-Fort Worth area, $230 a month tax. This one, he had it just as $330 for taxes and insurance. I don't know exactly what the breakdown there was, but it's probably pretty close to this, I would imagine. Insurance typically will run you about $100 a month, maybe a little more. And taxes, I know in Texas, tax rates are higher, like I was saying before. 230 would probably be pretty close to right. Let's see, 230 times 12. It's a little under $3,000 a year. It seems a bit low to me for Texas, but again, this is only a $270,000 home. And in my area here in Wyoming, homes are worth twice that much. This would be about what my tax rate is here on a home that is worth twice as much as what these are. So it just goes to show you, taxes in Texas are higher than some places like here in Wyoming where it would basically be half as much. Anyways, and then he did have reserves and maintenance. He combined into one number. I think in his video he said 140, somewhere around there. I just split those out. $20 a month for general maintenance on a brand new construction home, in my experience, is not bad. Depending on the quality of construction and how rough your tenants are on the home, that could definitely change. But in my experience with good tenants and a good quality of build, which you can ensure if you're building them yourself, $20 a month is fair. And then your reserves, 120 is probably a little bit low over a 15-year hold period. If this was like a 5 or a 10-year hold period, that would be fine, maybe even a little too much. But again, I wanted to use the numbers that he was actually using in his video. If it was me though, I'd probably like to see that around $150 a month. Again, I have a calculator for reserve contributions. I'll do that in another video coming out soon, where I'll share that with you guys and show you how that works. And you can actually determine exactly what your monthly contribution to reserves should be. So we did all this. And then for the tables, let's go ahead and take a look at that. So now you can see what I was talking about before, where it just kind of does a nice diagonal line right across the table, because everything is already lined up in order with the never sell strategy, where you're just doing one per year, year after year, right? So now we get our total numbers here. you can see that by the time you get the first paid off home, you're going to cash out refi that paid off home for $294,000, basically, assuming a 3% appreciation rate. So almost 300 grand tax free for that year, right? The next year, another 300 grand. The year after that, another 300 grand. The year after that, another over 300 grand, right? It's going up every year. But I just want to kind of point that out. That is the strength of the never sell strategy, is you're gaining hundreds of thousands of dollars every year from a tax-free financing on a paid off home, in addition to the cash flow that you have. So you can see here, your cash flow is increasing each year, right? From 15 homes, each with rent increases and whatnot. Your cash flow is increasing, what, about 15,000 or a little bit more each year. Here, you're jumping up about 20,000 from year 14 to year 15. Well, because you refinanced one of those homes, right? Your cash flow on that one home that was refinanced drops all the way back down to like $200, $250 a month, right? So you don't gain as much. And so in this case, going from year 15 to 16, you're only gaining about $1,000 a month, or sorry, $1,000 a year in additional cash flow from those properties because of the refi. But you're getting that $300,000 from the refi, all tax free. So your total income for the year goes from $155,000 off of cash flow the previous year to now $451,000 in a single year. Most of that tax free, right? You're still going to pay taxes on the $156,000 cash flow, but you're getting $300,000 of that tax free. So that is a huge, huge jump in income. Basically going from $12,000 a month to $37,000 a month in income, right? Just insane. That is the benefit of the never sell strategy. I can't point that out enough. People just don't, from my experience, people just don't have the ability to wrap their head around the benefits of this until they really see it on paper with numbers. You know, math doesn't lie. So obviously the assumptions that we're making here can change over time, but the concept, the underlying strategy stays the same no matter what, right? That this is going to happen. These numbers could change a little bit, right? This could be a 250,000 instead of 294,000. Let's say appreciation is not that good for the next 15 years. Let's say you're at 250,000 on the refi. You're still getting $400,000 that year instead of the 155,000 from cash flow only, right? So it's a huge jump. Again, you can go through and look at all the individual tables for this strategy, compare, you know, one house to another or whatever you want. But I think it's pretty obvious how this works at this point, right? So I'll just show you a couple more examples. This one is going to be what I do in my area. Okay, these are basically the exact numbers that I'm using for my new construction build to rents. And then I just structured this one per year because that's the whole plan, right? You do at least one per year. I will, in all likelihood, probably be building 2 to 3 houses per year, going into over the next 5-6 years, whatever. But for this plan, just to show the basic outline of the plan with my numbers from my market, I wanted to show just one per year, right? Now, in my market, like I was saying, these basic little rental homes, these are 1,200 square foot, 3-bed, 2-bath with a garage. That rental home in my market, this is a conservative estimate. It would actually be at a market value, an appraised value of around $450,000. I live in a very expensive market. I mean, you can't even find a home for sale here, a resale home for under $500,000. If you do, those get snapped up very quickly, unless it's like a tiny home or something. We do have a couple of those around that are for sale for like $250,000 to $350,000, which is insane to me for a tiny, I mean, they're priced at like hundreds of dollars per square foot, right? Absolutely insane. But a 1,200 square foot home, 3-bed, 2-bath in my market usually goes for around $500,000. A simple rental like the ones that I build, I would discount that maybe 50 grand, so about 450. To stay ultra conservative with my estimates here though, I actually lowered that all the way to a $400,000 value because I know no matter what, I will get at least $400,000 appraised value on each of these builds, and that's just based on my previous experience with this. Okay, and and also just market knowledge. I've been following my market daily. I mean, I check new listings, new rental listings daily in my market for the last 5, probably 6 years now, almost. So I know my market better than realtors in my market do. Like, I don't even think they pay as close attention to my market as I do. Maybe a couple of them do, but you know, there are some that just, they don't pay that close attention. All they watch is what their commission checks are. So anyways, $400,000 value. I build these homes for all in around 250,000, right? And then I added an extra 10,000 there for closing costs or whatever. But yeah, that is, I know people will tell me there's no way you're getting a $400,000 or $450,000 home for an all-in cost of 260,000. I do, because I build them myself. Okay, that's the key here, and that's why I say self-GCing your builds can be such a huge benefit, especially in markets where labor is more expensive, because then your GC is going to charge a higher fee. That's just typically how it goes. I'm a GC myself. I know how the game works, right? If you're in a cheaper market like Texas, obviously your GC fee is going to be lower just because that's the numbers there, right? But in a market like mine, I'm near Jackson Hole, Wyoming, a very, very expensive area in the country. As you can see, if a basic little 3-bed, 2-bath home is $400,000 to $500,000, obviously it's a very expensive market. But yes, materials still cost the same for me as they do for almost anybody else around the country. Labor is more expensive in my market, and that's why home values are so high in my market, because we don't have a lot of labor. Labor is extremely expensive. But because I perform labor myself, I can charge whatever I'm comfortable with for labor. So when I'm building my rentals, let's say a normal siding contractor here in my area would charge $30 an hour or $35 an hour, right, to install siding, which is high. You guys that do builds in other areas, you're probably hearing that and you're like, what? Really? I only pay $20 an hour to my siders, or maybe even less than that. It's very expensive labor in my area. That's why I like doing some of the labor. I'd rather pay myself that $30 or even $40 an hour for carpentry or things like that. I'd rather pay myself that money or a little bit less than that and keep the difference in equity on these homes, right? So if I paid myself full wages, going rates in my market for wages, this total purchase price would probably be closer to $300,000. I mean, it's not going to be that big of a difference, maybe a $30,000 or $40,000 difference overall. But because I am willing to do some of the work on these homes for a lower rate, I am able to build these houses for a lower price, which allows me to get all of my capital back out when I go to refi, right? Because looky here, 65% LTV, a very conservative LTV at a 6% interest rate. I'm still pulling out the $260,000 that I spent building it. And because I don't have unlimited capital, right? I have enough capital basically to build one house. And then I have to refi, pull the money back out in order to have money to go build the next house, right? But I build my houses with cash because I don't like financing the construction phase. I just finance once it's built. That saves me a lot of money on the financing during construction. It also saves me the hassle of having to do bank draws and all this kind of stuff. It's just a huge benefit to build with cash and then finance when you have the finished product. So that's what I do. And I build them myself. So I build them for a lot cheaper. That's the whole plan here. So I wanted to show you guys what numbers for me would look like in my market using my strategy, my method of acquisition, right? All these things. This is what my numbers would be. So I put in all the numbers. Again, in my market, taxes are very low. In fact, this is probably a little too high for taxes, but I like to stay conservative with my estimates. So I did $210 a month for taxes, $85 a month for insurance. It's about $1,000 a year in my area for landlord insurance. Maintenance, again, $20 a month on brand new construction is, in my experience, a fair amount. You're going to have many, many months where you have zero maintenance, and then you might have a month where you got to go fix, patch some drywall or whatever, unclog a sink. You'll have a couple $100 in your account by then to deal with that. Reserves, $150 a month. Again, I use my reserves calculator to determine this number. And then HOA, my area, my town that I build in does have HOA for all the neighborhoods in this town, and it's the same HOA for all of them. It's a very small town in the mountains of Wyoming, but basically $40 a month is the HOA cost here. So I threw that in there as well. And that gives us a total of just over $500 a month in expenses. Okay. Refis, again, one after another, 70% LTV. I dropped the rate back down to a 5.5%. I feel like that's much more likely long-term as an average than a 6% rate. Now, some years this might be 6.5%. Some years it might be 5%, but just as an overall average, long-term 5.5% is pretty good estimate, I feel like. Let me know in the comments if you feel differently, though. I am curious. Anyway, so refi number 1, refi number 2, the exact same numbers again, and refi number 3, the exact same numbers again. So if we look at the table here, you can see these numbers actually turn out really nicely for me once I get down the road to the refi phase. Excuse me, I got a lump in my throat there. So yeah, by this point, by the time I'm refining, and this is just doing one per year. Like I said, my actual plan will be to do 2 or 3 per year for the next 5 or 6 years until I have all 15 houses. So I'll start refinancing a lot sooner. But if I wait until the first home is fully paid off, that refi is gaining me well over $400,000 just on the refi alone. Add to that about $180,000 in cash flow from the whole portfolio. I'm making over $600,000 a year, largely tax free, right? I mean, I'm getting about 400K of that tax free. So that is a huge, huge income to have just being kicked off of a portfolio that you're basically passively invested in at this point. I mean, you still have property management to do, but that's about it. You could hire a property man. I mean, at this point, if you're making that much money in cash flow alone each year, you could definitely hire a professional property manager to manage the portfolio for you, or hire some employees, start your own property management company. But anyways, the point is you don't have to do really any work yourself other than just portfolio management. And you're making this kind of money at the end of the day. That's why this is my retirement plan. I will build more than just 15 houses, but my retirement plan, the portion of my portfolio that is specifically set aside for retirement, is going to be 15 homes, and it's going to be set up exactly like this, right? And then you can see all the numbers going across here for the acquisitions, for the refinances, et cetera, just like before. But yeah, that's mine. Now, the last one I'm going to show you, this is an example of an existing portfolio. I kind of mentioned this earlier. If you're curious what an existing portfolio would look like, I'm using the same assumptions here. We do have, I'll have to explain this a little bit. So all of these homes, just for the purposes of this Excel spreadsheet, I put all the acquisition years as one. Because you can't do like negative years or anything. But these are all homes that were already owned. They were purchased over let's say the last 7, 8, 10 years, whatever, right? Let's say an investor got started back in 2015, and they've been buying houses since 2015. They've been buying rentals, building their portfolio. So now they have a portfolio of 15 homes. And you can see that kind of reflected here. So the terms are all going to be 30-year terms. The LTVs are based on how much of that mortgage is left at this point. So if this first home was purchased in like 2015, 2016, then you might be down to about a 45% LTV now, depending on what you purchased at, right? But let's say with home appreciation plus your principal pay down over the last 10 years, you could very easily be at a 45% LTV. Back then, you may have gotten an interest rate of around 4%, maybe higher, maybe lower. I don't remember exactly what rates, and I didn't specify what year this was actually acquired in. Let's say it was acquired in 2000. I don't know, whatever. The point is, the interest rates are going to change based on when you acquired it, right? So I made some assumptions on interest rate here based on when I think these would have been acquired. For example, let's say this person acquired 4 rentals in like 2017 or something, right? 2018. They got those at a 3, or let's even say they did it in 2021 when rates were really low. You could have like a 2% interest rate here, right? If you bought down your rate and you bought it at the right time, whatever. But yeah, let's say these first couple of homes were like 2018, then you had 2019 for these, and then you hit 2020, rates dropped, you went and bought 4 more properties before everything went crazy in the real estate market, right? Then after that, because everything went crazy in the real estate market, 2021, you were only able to buy 2 more homes or build. I guess these are technically all builds, but regardless, it could be buy or build, whatever your situation. And these could easily be BRRRRs, right? So your all-in cost ends up being 190 for a 270K valuation at the end. And that is worth pointing out. The numbers that I used here for the existing portfolio, again, I went back to the Dallas-Fort Worth market numbers that I had from the other investors video that I found on YouTube. Just because I wanted to use numbers that I feel like are more common to investors. And I know a lot of people like to invest in Texas, Texas, Arizona, a lot of places like that. So the Midwest is even gonna have probably a little bit lower numbers than this if you're in like Iowa, Ohio, whatever, right? But I just wanted to use some numbers here that weren't crazy like my numbers are in my market, because my numbers are expensive and most people can't make investing work in my market. That's why I have very little competition for, in fact, I'm probably the only person here in my market that consistently builds rental properties, or even affordable homes. Most of the builders in my area like to target, that 800 to a million price range. And those are going to be like 2,000 to 3,000 square foot homes with a full basement, lots of luxury finishes, things like that, right? Not hardly any builders in my area will actually build truly affordable homes. And so that's what I go after because I'm building rentals. It's basically the same thing as I can also build spec homes and just sell them as an affordable home. But I have very little competition because I'm almost the only person in my market doing it. Anyways, these are, again, all 30-year terms, right? Because this is an existing portfolio. This is home or rental portfolio that somebody owned before they found the never sell strategy, before they decided to switch to 15-year terms. So let's say they start off year one, they have 15 homes all on 30-year mortgages with these varying rates and LTVs or whatever, right? And these could be anything. I just picked some values. But if you have an actual existing portfolio already, put in what your actual numbers are there, right? Then we get our loan amount calculation, and then refis start in year two, and it's just one refi per year because we're trying to get this whole portfolio lined up in the one per year payoff cycle, right? So we're refinancing each loan into a 15-year term, one per year. So year two, we got one, year three, we got one, year four, we got one, year five, and so on, right? These are going to be 70% LTV loans. These are going to be at a 6% interest rate again, 15-year term, and then same thing at refi number two, same thing at refi number three. Okay, very simple, straightforward. Obviously, these rates and LTVs could change, but just to keep it all simple, I just use the same numbers throughout. And then our expenses, again, are going to be the same as what we saw before for the Dallas-Fort Worth market. Very simple, easy to understand. Let's take a look at the table. So now you can see, starting off in year number two, we are now getting a new refi every single year, right? Now, because we're refining 30-year mortgages with varying degrees of payoff, their LTVs are, or their current mortgage to value is going to be at different stages here. Like you can see, this one's 69,000, this one's 66. So actually, we got less of a cash out refi on year three house than we did in the first 2 year, or the first two. Then it goes back up a bit, and so on and so on. And then by the time you get to your second refi, now we're refinancing completely paid off homes, because each of these refis, the first refis were all 15-year terms. So we come out 15 years from there, and now we're getting a refi on a paid off home every single year indefinitely. So from that existing portfolio, right? That existing portfolio, based on the numbers that I entered, currently cash flows at about $140,000 a year. Okay. Now, if we start doing this refinance cycle and all this business, obviously it's not going to increase very much for the first few years, because you are refining out of 30-year mortgages and into 15-year mortgages. But still, you don't drop any lower than $108,000 a year. That's basically the lowest you get for your cash flow. You drop from about $140,000 to $108,000 a year. So let's call that $35,000 drop in cash flow over those 15 years. But when you get to year 16, now you start getting your payoffs, right? The big payoffs. So this is where you're going to start getting $300,000 plus each year from a refinance of a paid off property, plus your over $100,000 in cash flow that you're still getting from the rest of the portfolio. And you can see your total income numbers just jump, they almost double, right? So you're going from a total, and I do want to make this clear, even though your cash flow is dropping each year for these first 15 years with the refinances, your total income, when you include the refi amount that you're pulling out, is going up, right? From your initial 140. Now it's not going to go up every year. You can see we go 215, 208, 202, 209, 204. So it's kind of bouncing around a little bit just based on what those loans were that you're refinancing, how much had been paid off on them and whatnot. But you are jumping. So instead of in year two still being at 100, let's say this would have gone up to about $145,000 cash flow for the year. That drops to $140,000 for the year for cash flow. But then you add to that your $75,000 from the refi, and you're up to $215,000 for the year. You never drop between two or below $200,000 as an annual income, using this strategy, right? So right off the bat, even though your cash flow has dropped, your total income has gone up significantly right off the bat. And that's before you even get to actually refinancing the paid off homes, right? This is all just when you're refinancing the 30-year mortgages. Then you get to year 16, you start refinancing paid off mortgages. And now all of a sudden you're up in the 400s and getting up to $500,000 a year in annual income, which is a huge increase for not really doing anything other than just keeping the same portfolio you already have and just restructuring your debt more intelligently, right? So that's kind of what I wanted to show there. So if you do have an existing portfolio, you're an investor that's been doing this for a while, and you want to see what happens if you take 15 of your rentals and turn them into the never sell portfolio, this is kind of how you can see what would happen, what those numbers would look like, right? So I did want to show that real quick as well. And you, of course, you have all your refis filled out over here, all your acquisitions here. You can look at the individual houses, the numbers for each house, and so on and so on. All right, well, we're almost an hour and a half now in this video. That's a lot more than I meant to do, or a lot longer video than I meant. I thought this video would be like 45 minutes, to be honest. But anyways, hopefully that was enlightening to you guys. Like I said, this file, not this one specifically, but I think it was this one. No, this one? No. Probably this one. This one. This is the one that I have available on the community, the Discord community, as a download if you want to go grab it there for free. Or like I said at the beginning of the video, feel free to shoot me an email and I can send you the spreadsheet as well. And actually I can send you any one of these that you want, but this is the base model. This is the one that I put on Discord for download. The never sell, just one build per year, kind of standard portfolio that I'm doing. This has all my numbers that I am currently using for my own builds. But if you wanted, let's say, the Dallas-Fort Worth market numbers, or the or you wanted to see the existing portfolio, I could send you any one of these versions that you want. So just let me know. Yeah, I hope you guys found this helpful. I will have some more videos coming out over the coming days, dealing with some additional Excel tools that I've created for my investing. I know I've already supplied the Gantt chart file to someone who found it very helpful. I have given out this portfolio planner file to a couple people as well, and they have found it extremely useful. So yeah, I'll leave you guys with that, and hopefully I see you again next time. Till then, have a good one.